So to kick it off, I'm going to ask Jonathan Bresman to come up. He's going to start off on the estate and trust stuff. Come on up, Jonathan.
Very much.
Yep, you're welcome.
I assume I need to stay by the lectern today.
Yes, please.
Okay. I'm used to wandering around over there. Couple quick updates. The big thing in the estate and gift tax area, I think Howard is covering, the Windsor case and DOMA. So that's the huge news. The Supreme Court invalidated Section 3 of DOMA, which said for federal purposes, marriage is between one man and one woman. They did not invalidate Section 2, which says a state does not have to recognize a same-sex marriage from another state. That's probably a violation of the full faith and credit clause of the U.S. Constitution, but that case did get up to the Supreme Court. It was sent down on procedural grounds, so that has not yet been decided. There was a case in Ohio. Couple had been together for 20 years, same-sex couple. One of them was terminal. They got on a plane in Ohio, landed on the tarmac in Maryland, which does recognize and have same-sex marriage. They got married on the tarmac, got back on the plane, flew back to Ohio, filed suit in Ohio to get an injunction to prevent Ohio from issuing the death certificate other than listing the survivor other than as a spouse. And they won that case. They looked at Ohio law, which is going to be instructive for dealing with this issue in other states. And looking at Ohio law, they had recognized, Ohio had a long history of recognizing marriages in other states that would not have been valid if entered into in Ohio, based on age, relationship, and they found there was no rational basis to therefore discriminate on this marriage because it was a same-sex couple. So Ohio now will recognize same-sex marriages performed out of state. A couple other quick updates. There was a case, it was actually a technical advice memo on material participation, fairly common technique. Business owner puts his business interest into a trust, has very restricted and gives the trust interests are all for the benefit of kids, irrevocable trust done for estate planning purposes out of his estate. Because of that, he keeps very little rights. He is still there running the company. He is appointed as a special trustee with limited rights on the stock. They said the material participation of the business owner as the CEO, the employee, is not imputed to the trustee, who was someone else. So the trust did not have material participation in the partnership or the business, and did not get and had to amortize over 10 years research and experimental expenses due to passive activity rules. So it's a material participation case, not imputing what he was doing wearing one hat to wearing another hat. There was also a chief counsel advice memo. Also a fairly common situation. Divorced couple, husband's required to take out life insurance, pay alimony, and then take out life insurance. Alimony ends on death. So often it's secured by life insurance payable to the wife. If the husband dies, she gets, the alimony cuts off, wife gets the life insurance proceeds. In this case, the husband kept the right to the dividends from the life insurance policy. It was a form of whole life policy. Husband kept the right to the dividends. IRS said keeping the right to the husband then died. Question is a life insurance policy in the estate because he kept the dividends? Is that an incident of ownership? And the IRS said no. Keeping the right to the dividends is really akin to just getting a reduction in the premiums or a refund of premiums paid. It's not an incident of ownership, not in the deceased ex-husband's estate. Last item I have for you is the estate of Warshaw versus the Director of Division of Taxation in New Jersey. This was a Madoff case. Decedent owned, had invested with Madoff. He put in $627,173.25. He got back, before he died in May of 2006, $1,113,338.67. Not a bad return on investment. Doesn't say how long he held it. After he died, actually the investment was in an IRA. After he died, the wife received distributions from the Madoff investment through the IRA of $185,000 in 2007 and $90,500 rounding in 2008. Of course, in December 2008, Madoff gets charged with security fraud, and there were no more payments out of there, and it became worthless. The estate filed a claim for refund, paid the tax based on back in 2006, then filed a claim for refund saying, hey, it was worthless. Alternatively, we should only be taxed on the distributions we actually got after decedent's death. That's all that we got after he died, because this turned out to be a Ponzi scheme, and that's therefore all the value there was in 2006 when he died. Tax court judge agreed with them. Tax court judge found that the IRA was valueless, but then granted the plaintiff's motion and concluded the estate was entitled to a refund based on a mistake of fact. Found for the taxpayer. It then got overturned by the appellate or Supreme Court. Let me take a quick look. Appellate division. They noted they invested in a high-risk, high-return pool of investment. He got a substantial return on that investment, and that no one back in 2006, there was no evidence presented that back in May 2006, anyone had any idea that this was a Ponzi scheme. Court held, because property is valued as of the date of death, the only relevant facts are those that this hypothetical buyer and seller could reasonably have been expected to know at that time. The exception is when circumstances are reasonably foreseeable as of the date of death. Again, still looking at what could you have known at date of death, and finding that, yes, it had a value. It had value that they actually valued it at on the estate tax return in 2006 and denied the claim for refund. And that's an Evelyn Wood update on a couple of points of interest on the estate and gift tax, and I'll turn the meeting back over. And Howard, I assume you're doing DOMA in much greater detail.
Thanks, Jonathan.